AM 1220 KDOW presents Money 2.0. Money 2.0. Now, with a focus on your mortgage and the real estate marketplace, here's your Money 2.0 host, Tony Mendes.
Welcome into the Real Estate Report. I'm Tony Mendes.
And I'm Gordon Hinds.
So we're going to get that changed so it says Gordon.
And Tony.
And Tony, yes.
Tongue and groove, TNG.
TNG. This is the Real Estate Report. We're talking everything real estate, Bay Area, California, and nationally, anything to do with, an opinion on helping you make a transaction a little bit easier. Second opinion on strategies. We have some really good strategies today about rental properties. Hope you could stick around with it. We're definitely going to talk about the rate hike. That's going to be in there. We have some emails and more. It's call-in show 800-516-1220, 800-516-1220. Email the show, Tony@BayAreaLoanSource.com. Pretty darn easy to get in touch with us. Rates are looking pretty good.
Rates looking very good.
Contrary to what a lot of people may have thought about what happened with the Fed rate hike, including leading up to it, rates are independent of what the mortgage rates are independent of what's going on with the Fed. Their rate is, on a borrowing rate. It's their short-term lending rate, and it's going to range between, 0.9 and 1.2. It's going to have some sort of number, but that's not mortgage rates. Mortgage rates are tied more towards the economy, more towards the flow of money, really tied towards the 10-year yield, which a lot of investors will go, okay, am I going to put my money here or am I going to put it in stock? So watching the stock market kind of drop or kind of level off the last couple of days, especially when the Fed comes out, Gordon, and they say, we didn't hit our 2% inflation target. That the stock market goes, I don't like that. And then money starts going into the 10-year yield. And then we have the ECB, which we'll talk about as well. They're saying we're possibly going to we're going to announce in September that we're going to keep our asset purchase program or quantitative easing through into 2019. There's just cheap money everywhere, and that's pushing money into safer assets like the 10-year Treasury.
Yeah, where we see the Fed rates hit the market, what it does affect the bank rates. So, for example, how much interest you get paid on a CD, 1 year, 5 year, 7 year. That's where you do see the difference. As the Fed increases their rates, you start to see those bank savings does increase to the consumer. The other place that you do see it, if you have an adjustable rate mortgage, as the Fed increases the rates, the index does go up, so that transcends into a higher interest rate for you on a monthly payment. You might not see it on the actual rate itself on the street level, but you do see it if you have an adjustable 5 year.
And you're already adjusting.
And you're already adjusting. That's where you actually feel that pinch.
Credit cards and certainly equity lines, as soon as this trickles into the prime rate, which most people are tied to, it's going to be like +1 or -1 or +0. So it's starting to look like equity lines are the secondary option to somebody taking cash out of their house, because right now 30-year fixed rates, even a cash out scenario with good credit, you can take cash out of your house at a cheaper rate than you can get on an equity line in a lot of cases.
Yeah, I mean, the competitiveness in the marketplace has made rates become a lot more competitive on the market. It's driving the housing market. It's as we always talk on the show, the same thing. It's the biggest economy booster in the country, which is the housing market. So as the housing market flows, so do the rest of the economy.
Why do you think somebody would, in this point in time, let's say an equity line prices out higher than a 30-year fixed cash out transaction where they roll their current loan in, they take a little bit extra cash, it could be 20 grand, it could be 100 grand. But that rate might be cheaper than an equity line. It probably is in most cases, especially after yesterday's news. What would be some of the cases where somebody would take an equity line instead of a 30-year fixed?
The biggest reason is ease of obtaining that equity line. If you walk into a bank right now, by the time you hit the door, there are 3 people asking you if you want equity line on your house. It might cost you $200, fill out a half a page or a 1-page application, or they have all the information already on you, and you can have a credit line in place in less than 30 days, where the traditional mortgage product that we go through, we run credit, we want copies of income documentation, we want your mother's birth certificate, we want appraisal, we want preliminary title report, we want all those things. And sometimes the equity line companies, such as the big box lenders, they don't even do preliminary titles or those type of documents. They give you a 1-page document signed, and bam, you have an equity line to start borrowing money on your home.
So some of the procedures may outweigh some of the benefits. For example, saving a little extra money, spend the time. I mean, it's always my opinion you're going for the better money, and that's to spend a little bit extra time. Let a good loan officer, a good mortgage company, a good broker take over your transaction and do it right. I think a lot of people, I don't like using the word suckered, but I think they were sold. into an equity line when they shouldn't have got one. I can think of another reason why you would want to get an equity line instead of a 30-year fix. First of all, if the rate on your first loan and then the rate on an equity line the aggregate rate is lower than what you get on a new refinance. And third is if you can pay that equity line off in a shorter period of time, because then you're effectively lowering that interest rate by paying it out sooner. For example, let's say you're doing a construction and say it costs $100,000 but you're not going to borrow that $100,000 right away. You're going to borrow 30 now. In 3 months, you're going to borrow another 30, and then you're going to borrow another 40 at the end. And then maybe you can pay that back in a 2 or 3 year period. And what you've done is you've borrowed the money, you pay it back over a shorter period of time. You're not really letting that interest rate kick in, and you're paying that down quicker. And then you're left with an emergency equity line that you could use at any time. And meanwhile, you fix your house and you left your first loan by itself.
There are many reasons why one would take an equity line over a standard 30-year fix. If you're already well into your timetable as far as your mortgage is concerned, meaning if you have a 30-year mortgage and you're in it 18 years, you might not want to start that recycle period all over again. The other issue is qualifying. In today's world, we're using what we call...
Can I comment on that real quick, though?
Sure.
Let's say you are 12 years into your loan, you have 18 years left, and then you get an equity line that say it's $500 a month, but maybe you do go to a 25-year loan, right? You're re-amortizing instead of 18 years, you're going to 25. But maybe the payments stay the same, and you're actually able to borrow that $50,000 or $75,000. So there's a little caveat there, Gordon, where there are cases where you can keep your payments the same by getting some extra money. And that works the same with credit cards, too, when you're paying them off.
You might be, but a lot of consumers, I talk to a lot of different homeowners, and they always want, for some reason, their focus is trying to pay the house off. And I'm always trying to counter against that. There's not a whole lot of benefit of owning a house that's free and clear. That's the reason why we always talk to insurance. That's why the reverse mortgages become popular, is because people have become house rich and cash poor, and now they need additional sources of income, and they go right back to the same asset they try to pay off, and boom.
That's a tough one for me to consider, Gordon, paying off a house, meanwhile watching the stock market go up 20, 30, 40% over 2 year, 3 year period. And house prices are slowing down a little bit, even though you're going to hear me talk about a story where they're up 6.8% year over year, but that's nationally. So there is some question of what do? Do you pay your house off early, or do you try to stretch it out and have a mortgage going into retirement? I think that's a conversation maybe for another day or later in the show. And I'm sorry if I cut you off, but I wanted to touch base on that. That's a lot of people do that, and they take debt and they pay it off, they re-amortize, and they can keep their payments the same. And that's one of the great advantages of having low interest rates right now. And again, this whole story started when we were talking about how equity lines are affected by the Fed raising interest rates yesterday.
I had a client that called last week after listening to the show. She has a house in Oakland. She's been in the house about 25 years. She's got about $115,000 balance on the loan. The house, all candor, is falling apart. She actually needs to take some money out the house to fix it up, to improve on the house, and she doesn't want to do it. Her whole focus is she's trying to pay the house off to preserve. She said, I want to preserve this house for my grandkids. And I'm saying to you, ma'am, the rate you're going, the house is not going to be here based upon the status of the properties. And I'm trying to say, look, you can still preserve the house for your grandkids. You need to take some money out to invest back into the property. But I don't think she's heard me in all candor, because I haven't heard back from her.
Cheap money, I think, is somewhat of the theme of the beginning of the show. We got an email from R1 in San Jose. He's looking to buy a $1.5 million purchase with 25% down. He's got good credit, and he's saying that he's considering an ARM, and ARM rates are about 1%, can be about 1% lower than a 30-year fixed. He says he could save about $600 per month if he got a 7-year ARM instead of a 30-year fixed, which is quite doable on a $1.1 million loan. ARM usage in the Bay Area, kind of picking up, and that's a little bit of the story as we're hitting new peaks in much of the Bay Area, and a lot of those with 20% down, or most of them with 20% down, are going to be in the jumbo territory, and ARMs start looking pretty attractive. And right now, the 30-year fixed, the 7-year ARMs are almost, for jumbos, are almost what they are for Fannie Mae, Freddie Mac conforming loan, Gordon.
Yeah, ARMs have become, as rates go up, of course, ARMs become more and more attractive. People are looking at short term. I think, as we talked before in the show, I think the average lifespan of people staying in the house is about 6 years. So if you get a 7-year ARM, one of the good things about the 7-year ARM versus a 5-year ARM, the 7-year ARM, you actually qualify the actual start rate, where the 5-year ARM, you actually qualify 2% above the start rate. So sometimes there can be a big difference in qualifying. There's not much disparity between the pricing between the 7-year ARM and the 5-year ARM.
And let me tell you right now, the 7-year ARM is pricing it with good credit and good equity, 20% down or more. You're looking at the 7 years almost pricing better in some scenarios, even in the jumbo territory. So, and you get that extra 2 years. You get to qualify at the full, at the lower, what they call the start rate. I'm kind of torn on it, Gordon. A lot of people follow that philosophy of, sorry, I have something something came off the mic into my mouth.
Or something came off your mouth into the mic.
And then right back into my mouth. Some people follow the philosophy that when rates are low, you get the fixed, and when rates are high, you get the ARM. What do you think about that?
I'm a starch believer in the ARM is the best product on the marketplace. However, no ARM is going to outperform anything less than a 4% 30-year fix. So that's the arena that we've been revolving for the last 5 years. We've been in that 4% 30-year fixed rate. No ARM is going to outperform that over time. So anytime you have an option for locking yourself on a 30-year fix, regardless if you think you're going to be in the property 5-7 years, because what we think today might not be the actual.
Let me run the numbers real quick.
Tomorrow,
R1's going to spend $54,000 less in 7 years than if you got a 30-year fixed. So
7-year fixed, he might not be able to qualify.
He may not. Yeah,
we don't know what rates are going to be in 7 years.
But he'll save $54,000. So there's an appeal there. And are people getting sold this, or are people just saying 30-year fixed? Let's just get the best pricing on that.
Well, everybody likes to go everybody wants to pay like sales. Everybody wants to pay the lowest possible cost. And sometimes I always tell people, never evaluate something by its cost. Always evaluate it from its benefit. So if you look at a sheet, you talk to, let's say you look at a professional versus a non-professional. Of course, the non-professional fee is less. But at the end of the day, when something goes wrong and there's no person to hold that person to fire, the great savings you thought you had right out the window. So always never evaluate something by its cost. Always evaluate from its benefit.
Who are you holding up to the fire?
Hold the professional.
Okay.
You can hold the professional's feet to the fire, but if you work with somebody who's unlicensed or not as prepared as we are, that have no consequence, you never know what you're going to get.
Just making sure that we're not putting the customer in the fire.
No, we hold the professionals to the fire. That's why we have licensing in each arena we're in. Contractor, no matter what phase of business you're in, we get licensed. That's why we get licensed. That's why we pay the fee. That's why we get the insurance.
A lot of people out there are still getting loans from people who are not licensed.
Absolutely.
And even the companies with licenses are still making mistakes on. Did you hear about the Wells Fargo thing where they're, I don't want to misquote this, so I'll probably come back after the break and talk about it.
But Wells Fargo makes a mistake every other week, it seems like.
All right, we'll come back after this break here on AM 1220. You're also welcome to call the show, 800-516-1220.
Or email us.
Tony@BayAreaLoanSource.com. 800-516-1220, or email us, Tony@BayAreaLoanSource.com. We'll be right back after this break. This is Tony and Gordon in the Real Estate Report.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I am Tony Mendes.
And I'm Gordon Hinds.
Thanks for sticking around with us.
Warrior celebration today, Tony.
It was.
Did you go?
No. Work. Radio show, work.
Well, in solidarity, I got on my Warrior shirt.
You do. I'm not going to mention the other thing that you did.
Okay, no worries.
So we kind of, use a professional, I think is what our last segment came down to. There are people who are still originating loans that aren't licensed, and then there's still licensed big banks that are making mistakes. One in particular, there's a class action suit because they were making changes to loans for people that were in bankruptcy. Now they haven't been convicted. It's worth noting that, but making changes to loans through like some temporary loan modification thing, just so that they stretch out the term, they end up paying more money to the lender. Possible for, it's just you got to use a professional who lays it out and is is honest with you and has been in the business for a while.
Well, the whole mortgage crisis, as they say, too big to fail. A lot of the big box banks think they're too big to be punished. So these guys do things without any accountability, and nobody never gets punished. If you go back to the mortgage crisis, where we say nobody went to jail for mortgage fraud, regardless, only from a few little guys. But the big banks that were pushing that highly profitized from the crisis, nobody ever went to jail. But that's just a sign of times in the world. The world, I think the guy who has the money makes the rules. So therefore, the guy who makes the rules, they're never going to punish him or herself. So there you have it.
You can always call the show 800-516-1220. Email the show, tony@bayarealoansource.com. We're going to talk about technology in just a minute. Meanwhile, tight supply and strong demand pushing record-setting sales pace right now, according to Redfin. The average home in May sold in 37 days. It was 40 days before that. The listings are declining as well, down 11% year over year, leaving only 2.7 months of inventory nationwide. San Jose made the top 5 cities in the United States with lost inventory in 1 year at 31%.
Wow. Where did the inventory go?
Don't know.
People are not selling?
All resulting in the median home price jumping 6.8% year over year in May nationally. Again, we watch statistics like this. We see the ECB saying we're going to keep our rates low. They're at 0% right now, and they're going to keep their purchase plan going through up to 2019 at least. And you're sitting on the sideline. You should be asking yourself why.
I don't know. At some point in time, the rubber has to meet the road. That's what I kind of say. If you look at supply and demand, basic economics, of course, the old theory: the higher the supply, the less the demand. Of course, the lower the price. As you decrease supply and increase demand, the higher the price. So some point
First
in time,
thing you learn in economics.
Some point in time, we're going to have to break even. If we keep saying every week, there's no supply out there, at some point in time, it's going to have to reverse itself because we're going to have to start the cycle all over again. Who knows when the time's going to be, but it's going to have to happen.
I missed registering for my economics class at Virginia Tech by like a day. And I ended up having to watch it in a kind of some sort of sub room way across the campus on TV. I was really upset that I never got to sit in this massive auditorium with this guy. Anyways, I did take out the whole supply and demand out of that class. Tell us about technology, Gordon.
Well, Uber is testing. What is Uber testing? What?
Self-driving cars.
Self-driving car. Well, there's a company that's going to be testing what they call a self-driving mortgage, which is kind of scary if you look at it from our standpoint, being industry. I guess the problem with our industry, as we always complain, the mortgage industry has, for some reason, not embraced technology. There's so many technological things that we could have done, should have done, that we're still not doing. It's kind of really slowed down our process. So at some point in time, I think it's just going to break out and just happen overnight. So the self-driving mortgage is you go online, you plug in your numbers, you come up with your loan, you write your paper, you sign your own documents, somebody validates, and boom. That's what they said about self-driving cars. I don't know about that. So we'll see. Time will tell.
I think that the mortgage industry is going to follow the real estate industry. There are two different industries where 68% of buyers today still shop with a realtor even before they go online. All right,
well, that's where we are now, but George Jetson might agree with me, but if you look at the sign of the times, everything we do is an app. There's a new program on TV right now where these guys, you go on TV almost like, who's the best dance in the world, who's got the best apps. You go on these shows and you present your app, and Apple and Netflix and all these companies are sponsoring these programs, all trying to get the app. Who has the best, quickest widget, and that's where we've gone. Like it or not, technology's here. We have to find a way to embrace it in our industry.
We've done our best. A lot of the companies that we use are quite paperless when it comes to disclosures. Still a few things that you have to sign, but it is getting better. I don't want you to take out of what Gordon said. The industry is working on its best to systematically.
It's taking its time. How's that? It's behind the times.
Fix all. Yes, it is. You're welcome to call the show, 800-516-1220, 800-516-1220. You can always email the show, tony@bayarealoansource.com. We're going to come back. We have another good email. We're going to talk about credit scores because more and more these credit scores are affecting people's rates and pricing when it comes to
products. Certain products, if you don't have the credit score, you can't get that product.
I want to talk about that when we come back after this break here on AM 1220 KDOW. I'm Tony Mendes, and it's Gordon Hinds, and it's the Real Estate Report.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendes.
And I'm Gordon Hinds.
Thanks for sticking around with us. Talked about equity lines. We've talked about the ECB a little bit. We've talked about the Fed rate hike. And somebody heard us and gave us a call. Kirk is on the air. What's your question?
Yes, I'm struggling to, I came in the middle of your show, by the way, but I'm struggling to get a home equity line. AVM was done on the property. It's worth $850. I owe about $450, my problem is I file married joint filing, and I'm income rich and credit poor, and whereas my wife is credit rich, and but her income is not quite high enough to get the loan itself with her debt to income ratio. And I was wondering, we're both self-employed, and I was just wondering how if we applied together, they're going to look at the lowest credit score, and that precludes us from getting a home equity line. I was wondering, is there a way that I can shift my income under her umbrella, and she becomes the applicant with good credit and now more income to allow us to qualify and get some of the equity out?
If I can just ask one question, you're both self-employed. Do you guys work for this? Do you work for your same company? You work for yourselves together, or you work separate industries?
Separate industries.
Separate industries. Okay.
Although in my industry, she is also on my license as an employee, but of course we're both self-employed. So she's quasi part of my company, but she has her own independent company as well.
Okay.
So you filed 2 Schedule Cs? I'm just trying to make sure I understand.
Correct.
On your okay. All right. Okay. I understand.
So this, and thanks for the call, Kirk. I understand you want to listen to the answer off the air. You can call the show 800
or maybe, you know what? Just go forward, please.
Go for it. We will go for it. So this is kind of a classic scenario that we see a lot, Gordon, where
Absolutely.
we have income from one person and low credit score, and then we have a better credit score, and they always go, hey, can we just add somebody that has a better credit score? Yes, Kirk's right. They're going to use the lower of the 2 credit scores. And in order to use the income from the other person, they have to use that credit score. What do you think about this, Gordon? It is a classic scenario. It is an equity line that he's looking at. We know that equity lines have a higher credit score requirement. Usually 680, 700 is usually their target. What do you think about this?
Well, he mentioned a couple of things. And most people didn't catch it. AVM, as you mentioned, and AVM is an automatic valuation appraisal method. That means no person goes out. They just kind of pull up a value online and just kind of. He said his AVM value was 850, and that's why we talked earlier. That's why the equity lines are so easy and fast to get, because we don't go through the traditional process. He's in a challenging situation. The first thing I would actually look at, I would like to see his credit report and see where we can try to get his credit score improved. We do with our credit bureau's rapid rescore, which we can go
what
in.
if scenarios.
What if scenario to tell you, if I'm trying to get the optimum credit score for 720, what will we have to do to this borrower to get him to 720? As we talked earlier before we went to the break, a lot of products on the marketplace, you're not eligible unless you hit those 700, 720s, even 740 plateaus. They don't care how much you're making, you're just not going to get a shot at that product. So the first thing I would look at with him is to try to look and see if we can get him rescored and see what his issue is. Then I go back and look at his wife, see what her credit score is. They're both joint. They're both married. They both filed jointly, but it doesn't matter who makes the most amount of money. They're going to go off the lower of the 2 credit scores if they're combined.
Is Kirk still on the air?
I am. I'm still here.
What was your credit score?
Mine is around just above 600. Hers is 720, and mine, as you mentioned, the rapid improving my credit score. I was a cosigner on a couple of student loans. That's weighing me down. Otherwise,
okay.
Well, not otherwise. That is the case, and it's weighing me down.
Okay.
I have
I think one of the
yes, that's it.
I think one of the other options might be as well, Gordon, is to just look at a total refinance to take the cash out. I know that's a low credit score. How much money are you looking at to get?
Well, the equity that's there is $400,000. And of course, I could only, do 80% of the value of the home, which.
So you're looking to max out what you can get.
Exactly.
Okay.
Thank you.
Okay.
So the only thing I can think about, we haven't asked about income. Is it possible that the wife can qualify on her own? And that's the only way I can.
What about amending their tax returns? Maybe. We'd have this is one of those cases where you and Kirk, thanks for the call. Where we really got to sit down and look at what they have and see if there's some depreciation in there that you can back into the income. Maybe there's one way to use a 1-year tax return program, because ultimately we want to avoid using. There is somebody who's going to loan you money, but it's going to be at a higher rate than much higher than an equity line. And to avoid that, you want to stay mainstream. We'll try to finish, maybe come back and talk a little bit more about this. We'll come back after this break here on AM 1220.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendes.
And I'm Gordon Hinds.
Thanks for being with us.
That was a great call.
It was. And Kirk, thanks for calling. Anybody call the show, 800-516-1220, 800-516-1220. We're kind of brainstorming during the break and trying to figure out what other options Kirk might have. There's, when you co-sign for someone and you can show that that other person, even though there's maybe some late payments, you can show that the other person's been making the payments. You can get yourself absolved of that debt over a 12-month period. That could be one option. There's depreciation that is possible on a Schedule C that you can put back in your income. Not sure if that equity line company has looked at that. The other strategies for Kirk, we didn't find out why he wanted the money, but if he absolutely needs the money, maybe he does something like an FHA cash out loan. You can max that out up to probably a $636,000 loan and use both incomes and use the lower credit score, possibly maybe after we fix it a little bit, and then let that new loan pay off some debt, do whatever you need to do with it, and then hopefully the credit score goes up, and maybe a year or two later we fix that. There's a couple things to do there, and I appreciate the call because this is a real scenario that a lot of people out there are running into, and it's not just that, Gordon. We talked about the co-signing and how a lot of people get into trouble that way. They co-sign for a credit card. We have a guy right now. He's like, I don't know what that credit card is. I go, well, it's got a big A next to it. What does that mean? Well, that means you're an authorized user. Somebody at some point added you as a user, and they made a late payment, and it's affecting your credit.
Yeah, we see it all the time. I've seen that. Believe it or not, I've seen that authorized user come back to hurt a client who they actually used themselves, filed for bankruptcy, and that thing was reported on his credit report as a bankruptcy issue, and we had a heck of a time trying to get it off. But once you co-sign for someone, that means that you're saying, if this person doesn't pay, I will. That's what you're basically saying. You're at the wrath of how they pay their bills. So, for example, you co-sign for anybody, and you can make 100% of your payments on time, and that one particular payment that you co-sign for, they didn't make the payment, you better make it because it's going to really dearly hurt your credit score. Tony mentioned earlier, if you can show 12 months canceled checks, you can get them we can get them reprieve from the debt in a debt ratio issue, but we can't get the reprieve from the actual credit score issue. So that's always a challenge and the problem in co-signing. Be careful who you co-sign for because it's just like your twin brother. And Tony has a twin brother, by the way, right?
I do.
Would you co-sign for your twin brother? Don't answer that. He might be listening.
He might be listening. Yeah. I'm not going to answer that.
Okay.
Thanks for the call, 800-516-1220. The ECB is expecting to announce in September that they're going to continue their QE, their quantitative easing, through 2019 while maintaining its tapering to give some wiggle room if they need it later. This asset purchase program is meant to incite economic growth and inflation. On top of this, their Fed rate equivalent is at 0. What this means for us is rates could stay low for a period of time, Gordon. And people forget a little bit about what's going on in our economy, get caught up in the Fed increase. Meanwhile, we're a global economy, and the ECB has a big play in that when people are looking at 0% interest rates and they can bring money here and keep our rates low.
Well, as we always talk, we're in a global economy. Everything that happens overseas across the pond affects us here at some point in time, sooner or later. It's almost like sharing a driveway with a neighbor. I have a property, by the way, and I share a driveway with a neighbor. The guy blows half the driveway. Could you believe that? When I blow the driveway, I blow the whole driveway. He blows half the driveway. Like it's not going to affect my side. It's not going to affect his. Kind of interesting.
Is he blowing everything onto your side?
He's probably blowing everything over to my side, knowing that person. But all I'm trying to say is we're in a global economy. Everything happens as it were, it does affect us here. So when our economy is working on 80 or 100% cylinders, if the other parts of the world are not working on those type of cylinders that we're working on, we have to kind of slow our business down and kind of become informed because they're defaulting on their World Bank loans affects us here in our marketplace.
We're going to have a segment called Crazy Neighbor.
CrazyNeighbor.com.
Crazy Neighbor emails, yeah.
Yeah.
Send us your crazy neighbor emails.
Yeah,
I love some of the
the
stories
guy
we
blows
hear.
half of the driveway. I couldn't believe that, man. And he had a blower. I sweep the driveway. I sweep it with a broom. But anyway.
Old-fashioned.
Anyway.
Gordon is old-fashioned. Yet you will eventually embrace this whole, I'm not going to call it auto mortgages. We did get an email from Mark in Palo Alto. I love this email because I'm a scenario type of guy. He owns his house free and clear, $2 million house, Gordon.
Wow.
He's in Palo Alto.
Probably 2-bedroom, 1-bath, huh?
I want to take out $1.2 million to buy a 2 to 4 unit rental building. What are the rates for this when I take the cash out? Okay. So we aren't going to quote a rate. I mean, that's quite obvious. But what we'll talk about is the scenario and how his scenario might not make as much sense as a different kind of scenario. First, a cash out jumbo, you're likely going to be a quarter to half a point higher than if it was just a regular 30-year fixed. And second, why take all the money out of the primary residence when you can borrow the money on the rental property? So, and third, if he takes the money from his primary residence, does he get the full interest deduction? You got to check with the IRS, but I already know the answer to that. You don't. So what I would consider in this scenario is I would probably borrow the max amount you can on what they call the conforming limit, which is $424,000 in Santa Clara, and take that as cash out. You're going to get a below rate of what you would get on a 30-year fixed jumbo, and then probably buy a 2 to 4 plex unit. The conforming rate for a 2-plex is only $814,000. So 814 plus the 400 from his house, that's 1.2 million. And that even goes, a 4 unit goes up to 1.2 million as a conforming limit. And then 3, if he buys the rental free and clear, he actually has more income that's taxable. So you may want to throw a little bit of debt onto that property. Your CPA may be a little bit creative where they can take some of the interest from the money that you borrow from your primary and tie it into that debt. Of course, talk to your CPA about all this. So then, my suggestion is to stay conforming in both the loans and, put 25-30% down on that unit and get some good, both of the rates, and I priced this out, are lower than what you get on a 30-year fixed jumbo cash out.
I love those kind of emails. I mean, here's a guy that's the epitome of where everybody should be. That guy has options. Once you have options, especially financial options, that means that you have done your homework. You've done well over the years. So if he owns a house, a $2 million house, I need to talk to that guy and see what he's doing so I can own a $2 million free and clear. So if you have a house that's free and clear at $2 million, he's got options. He can do whatever he wants to do. He can get an equity line. He can take cash out. He's got a lot of options to do. So we just need to sit down with him and map out the strategy that's going to make the most amount of sense economically, financially, and of course, legally, what's going to work best for him.
Right, with the CPA. And the other thing too is qualifying is easier if he puts more debt into that house. If he has to qualify for the full amount if he gets it on his primary, but if he gets it from the rental, the rents can offset the debt. So it might actually be easier to qualify putting more money into the rental. We'll come back after this break here on AM 1220. You can always email the show, Tony@BayAreaLoanSource.com.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendes.
And I'm Gordon Hinds.
So we can talk about one of these stories here, Gordon. The mortgage market is now dominated by non-bank lenders, or we can talk about Google's Moffett Field modular apartment plan.
No, man, we got to stick to mortgage. I like the mortgage industry now dominated by non-bank lenders. That's what we were kind of alluding to earlier. The big guys been dominating us for many, many years and then beating us down with legislation. And now finally the guys like us that hit the street, they go out and bring in business. It's paying dividends.
2011, 50% of all new mortgages were loaned by the 3 biggest banks in the United States, JP Morgan Chase, Bank of America, and Wells Fargo. By September 2016, the shares of these loans by these 3 banks dropped to 21%.
Wow. What's that, a 30% decrease?
Yes.
Wow. Incredible.
The impact is bigger on the housing market overall because without the non-banks, we would be even further behind where we should be in terms of the number of transactions, according to a consultant with Navigent Consulting in Washington, D.C. named Paul Noring. I find it is, that's a true statement. We would be far behind. There wouldn't be asset depletion loans. There wouldn't be the wholesale lenders that are out there reaching out to every broker to initiate some new program. And we do non-large bank lending.
Well, one of the things that kind of really puzzles me, and that's what we were talking about earlier, we went in after the mortgage crisis, we went to national licensing, which our industry is now regulated by what we call the NMLS. Everybody in our businesses technically has to have a license, unless you work for a big bank. They give you a number, the same number we have, ML, but there's no qualifications behind that number. So I'm always trying to figure out, well, wait a minute, how the guy working at Wells Fargo doing loans, he's got an MLS license, but he never took any classes, he's not required to do it, but how are they doing loans and we're supposed to do, qualified mortgages? That always puzzles me.
Yeah, that's, I've stuck with my guns over the years, saying that I always liked brokers because they use a lot of non-large bank lending, a lot of wholesale lenders, as we call it, because we have options. You walk into our establishment or any broker establishment that's been around for a while, you're going to have options with your loan scenario where the big banks, they're cookie cutter. If you don't fit their cookie cutter, you are not going to get a loan with them. The higher credit scores, sometimes they might offer a lower cost loan or a decent rate, but if you don't fit, I've heard some people say that because they didn't have assets there, they wouldn't even talk to them.
Well, a lot of the big banks have moved, actually. They moved out of equity lending, is what we call it. They're into what they call wealth management. So what they want to do, they want you to bring them their money, your money, invest 100, 150, 200,000 in their bank, and they want to manage your wealth for you. That's how they want to make money. They don't want to go out and peddle loans, and like what we call it here. And that's the reason why when they're doing loans, if you have an 800 credit score and you go to a big bank, you're going to get that loan closed quickly. If you have a not so high of a credit score, it's going to take them 60, 90 days to actually close that loan, because it's actually, they don't want to decline you, but they're actually kind of saying, well, maybe if you slow it down, the client will go somewhere else. That's my thought process.
Well, with that said, I think no matter what you do, start early, work with a professional, and get options. And that's where large banks don't really
that's what we do.
excel.
We give options.
They don't really do options. You're welcome to always email the show, Tony@BayAreaLoanSource.com. Visit our website, BayAreaLoanSource.com. Gordon loves investment and going over investment strategies. You can always email him, Gordon@BayAreaLoanSource.com.
Or if you missed the show, you can always go back and live stream us, correct?
You can. We're going to start doing. If you go to our website, you can sign up for our newsletter. We'll start doing the sending out our podcast page.
Yeah,
we have a new podcast page, and you can listen there. In the meantime, you can always
every Thursday,
yeah,
6 to 7, drive time special. Thank you for listening.
We'll come back next week here on AM 1220 KDOW. This is Tony Mendes and Gordon Hinds with the Real Estate Report.